Hello, I'm Wesley Barkus, and today I will be presenting you with Case A. Why is the T-bond rate shown to be independent of the economy? Well, this is because the Treasury must redeem all T-bills at par value no matter what's going on in the economy. The second question is the return on a one-year T-bond risk-free? It's nearly risk-free from default risk because it's fully backed by the U.S. government. For number two, we were expected to find the expected return for all four alternatives. So for the T-bond, we found that it was 3%. For Entergy, we found it was 7.5%. For Freeport, we found out it was 5.9%, and the S&P 500 was 9%. So we concluded after analyzing all possible outcomes that the S&P 500 is the best result. For this problem, what we did was we measured the standard deviation and the coefficients of variance. Now, what standard deviation measures is the risk, and coefficient of variance measures the risk and risk of expected return. So after running our analyzation, T-bond has a standard deviation of 0 and a coefficient variation of 0. While Entergy has a standard deviation of 6.407 and a coefficient of variation of 0.854. Now Freeport has a variance of 30.490, a standard deviation of 5.522, and a coefficient of variation of 0.936. The S&P 500 has a standard deviation of 9.859 and a coefficient of variance of 1.095. Suppose we put $10,000 into Entergy and $10,000 into Freeport, making $20,000 in the portfolio. That would make an expected return of 6.7 with a standard deviation of 1.7 and a coefficient of variation of 0.25. Now, when we underload Entergy and overload Freeport, we get a standard deviation of 2.9 and a coefficient of variation of 0.46. Now, when we overload Entergy and underload Freeport, we get a standard deviation of 3.7 and a coefficient of variation of 0.52. So now what we did was put $10,000 into Entergy and $10,000 into the S&P 500 evenly weighted. Their portfolio ER is going to be 8.25 with a standard deviation of 8.12 and a coefficient of variation of 0.98. So this investment is actually riskier than the former one due to the fact that its standard deviation and coefficient of variation is higher. Investors started a portfolio with one randomly selected stock, and that he started to add more randomly selected stocks to that portfolio. Well, that would increase the risk of that overall portfolio. Now, what are the implications for the investor? If more stocks are added, it would implicate the investor needs to take more financially responsible decisions to decrease the risk and diversify in known stocks. Do the portfolio effects impact the way investors should think about riskiness? Yes, it would. If the company was risky, it would have a higher beta, and that could scare off investors. Now, B, explain the differences in total risk, diversifiable risk, and market risk. Well, the market risk is the underlying risk that is always there. Diversifiable risk is risk that can be lost or lessened with a well-diversified portfolio. Here I ran a regression on the S&P 500 and compared it to Freeport, Entergy, and the T-bond. Now, these lines right here are called market security lines. And the slope coefficient is also known as regression. Now, the significance of these lines is that it will help you figure out if a price of a stock is under or overvalued. Here I calculated the required rate of return using the CAPM on Entergy stock with a beta of 0.6. We found that the required rate is 6.60%. Now, they ask us if investors should buy Entergy Corp. And I believe so because the expected return is higher than the required return. Now, what would happen if the expected return, if market risk premium rose from 6 to 7% and the beta went from 0.6 to 1? Well, that would make it that the required rate of return would rise and the expected rate of return would drop. So you should not invest. What would happen to Entergy Corp's required rate of return if inflation expectations increased by 3% above the estimated embedded in the 3% risk-free rate? Well, as you can see here, the required rate was 6.60%, and it would increase to 7.80%. Now, what is the efficient markets hypothesis? This is the hypothesis that everything in the market is accurate and all of the information is also accurate and the pricing is fair. Now, they asked us what impact does that theory have on decisions concerning investing in securities? And I believe that it would make it much more difficult to invest because information is not always accurate and stocks are not always fairly valued. Is it applicable to real assets such as plant, property, and equipment? It is not. What impact does EMH have on corporate financing decisions? Well, since EMH assumes that all stock prices are fairly priced, it has a negative effect on investing decisions. It is not a productive or an accurate tool to use for investing. And the second question is, should James Smith be concerned about the EMH when considering adding his staff of security analysts? And I believe he should be concerned because security analysts and the information that they put forth has an overall effect on the company's valuation. From 1994 to 2004, the total debt to asset ratio decreased. Now suppose that it continued to decrease in 2005. What would happen to this company's beta? This company's beta would decrease due to the fact that it would become less risky to the market due to the fact that they don't have as much debt. Now, Energy Corp's rate of return would increase from this. Thank you for watching my video.